In this video, I want to take you through and I want to put on an iron butterfly. Now, the reason I want to put on an iron butterfly is because this morning in our lab online, we put on an iron butterfly, and I didn't explain it very well because I wanted to get it on very quickly and then kind of explain it after the fact. It's a lot easier to explain an iron butterfly as we put it on as opposed to after the fact. So I did an after the fact on the iron butterfly this morning, and we're watching that. It's running throughout the day right now. We put that over in on the futures market with a 0 DTE, 0 days till expiration. We're day trading that iron butterfly over in the futures market. But I want to kind of explain a little bit better how to put on an iron butterfly and why we put those on and what the implications are of an iron butterfly. And I'm going to do that here in the futures market, and we're going to do it on the Qs, all right, here on the Qs. So we're looking at the Qs, and we're just going to take a quick real at the Qs, and we're going to say there's our previous high right back here, July 19th, and this market has broke that previous high, and it's just kind of started to go sideways. It's just doing a little sideways dance. Now, I'm bearish on this market to some degree. I think that this market's going to eventually kind of pull back and give us a little bit of a retracement. But those blue lights have to intercept. So it's got to intercept those blue lights. And so the process is to watch for this market to come up. We got our natural trend line right in here. It's broke that already. And now we're coming in with the mathematical trend line. You've seen me do this with the spider web, and so this is the little spider web strategy. Of course, then I do the horizontal, which comes along clear down here. Now, we're not going to expect the market to come all the way to the horizontal anytime soon. Not that it can, it certainly can, but we're going to be more mindful of the Fibonacci ruler, which comes in. We're going to just measure from the low to the high, and the current peak is today's bar. So that broke the new high today, but then it's pulled back off of that. And so that creates a Fibonacci sweet spot right down in this region here. This is kind of where we're going to anticipate or look for this market to come to. Now, how long is it going to take to get there? Well, we can use Fibonacci once again to kind of help us identify price and time. So we're going to come in from A, B. We're just going to go to the high. If it breaks a new high, we'll redraw it tomorrow, or each day it makes a new high, and that'll readjust our price and time target. But this is where we're looking at as of today. We're looking for this market to come back, and this would be a 61.8, 78.6, 100% projection on the Fibonacci time scale and projection scale, which would be a 38.2, 15, 61.8% retracement against this previous trend. So if you look at it from both directions, both a projection and a retracement, that's kind of how we're looking at it. And this is where we end up expecting the market to be in price and time. So if it stays within the same volatility scale as it's been riding, this is where we'd expect it to be right back in this sweet spot sometime around December 11th, December 12th, sometime in this region here. That's where we'd expect it to be down in here. So what we're going to do is we could put on an option strategy that would take advantage of a market moving down. And we've done that in other videos, but this is an example of how to put on an iron butterfly. So we're going to put on another iron butterfly. And because we are bearish on this market, we're going to be a little bit cautious. We're only going to do a 5-day iron butterfly and just anticipate that maybe this market's going to go sideways for the next few days before it actually drops. We're going into a Thursday, Friday, and then a weekend, and then the option will expire on the following Tuesday. So we may liquidate this thing before we go into the weekend, but we'll have all that weekend decay, which would be nice. We could liquidate it Monday morning if we wanted to do that. So there's a number of different things that we could do with this option, but for now I just want to mostly spend a few minutes putting on an iron butterfly and show you the advantages and disadvantages of it. So if you can't see the disadvantages of an iron butterfly, don't put one on, because there's always disadvantages. If you can't see the advantages, obviously you're not going to put one on, but we're going to look at the advantages and disadvantages and how to put that on. Now, there's a number of ways to put it on. Once you become more adept at trading and you just want to put on an iron butterfly, you can just drop in here and go to the options tab in Track and Trade, slide down here, find your iron butterfly, flip it, and it's just going to plop it on the screen for you. And then you can adjust the wings however you want. But that's the quick and easy way, the dirty way of doing it if you're already familiar with iron butterflies. But I'm going to come through and I'm going to build one leg at a time just to kind of help you understand a little bit about what's going on. The biggest problem, the reason why most people lose money trading, is because they don't understand the concept of the strategy that they're putting on. It's like playing chess. If you don't understand the strategies, then how can you win at chess, right? You have to understand the strategy. An iron butterfly is just a strategy that we play, just like in chess. It's a strategy that you play. So we're going to play it against the market, and the iron butterfly strategy is a strategy for a neutral market, all right? It's for a market that's going sideways. It's not for a rally market. It's not for a falling market. It's for a neutral sideways market. So we're going to put that on today. Again, we're a little bit bearish on this market, but we're going to put it on in anticipation that the market doesn't do anything for the next couple of days and then going through the weekend. So this idea is that what we do with an iron butterfly, and I'm going to pull up a little graphic here for you very quickly. Okay, and here's the little image that I wanted to draw for you. So this is an iron butterfly, and this is just kind of what it looks like, all right? What we're going to do is we're going to be putting on an iron butterfly, which is selling or writing, okay? We're going to write a straddle at the money, and then we're going to buy or hold a strangle, 2 to 3 or even more out of the money options, okay? So this is what it's going to look like on our screen. We're going to buy a call, and then at the money, we're going to sell a call, and then we're going to sell a put, and then we're going to buy a put. All right. So the implication of that is that when you sell your options, you're going to collect the premium, right? But when you sell an option, you have unlimited loss potential. So the reason we buy the wings, which is why it's called a butterfly, is to put on insurance. Okay, so those are our insurance policies. And the farther away we put our wings, the farther away or the more what I like to call your deductible. Okay, so that's your deductible. And so that's the difference between where you got into the market basically and where you would get out if you were wrong. So that's your deductible. But in reality, when you're doing options, you're not getting in and out. You're selling your call and then you're covering yourself with a call that's going to cover the losses on the unlimited loss side. Okay, so that would be your deductible, the difference between the sold strike, okay, and the bought strike, between, in this example, 50 and 70. So the distance between there would be your deductible on your insurance policy. So that's what the calls are, and the bought call and the bought put are. They are your insurance policy against this market going wildly outside of your profit box. All right, so let's go put these on, and I'll show you how that works. We'll do it one at a time, and we'll look at the calculator as we put these on. So we're going to come back here, and I'm going to go down to a 15-minute chart, just to make it a little easier to see. So we're going to come down here to the 15-minute chart, and we're going to put these things on. And I'm going to come into the options chain, and we're going to go out 5 days, which is going to be over the weekend and coming into 1, 2, 3, 4, 5. It's going to be Monday. This thing's going to expire. So expire Monday, close of business Monday. So that's on 12/4, and today is 12/29. So we're going to go through, and I'm going to very easily, the very first thing we want to do is, well, we could do it by dragging and dropping. So very easy, makes it easy to do. We're going to come in here, and again, I want to put this out here 5 days, and we're going to buy a call. So the very first one out here on the wings, and we can adjust these. So we're going to go buy a call, and we're going to sell a call. So we're going to sell a call at the money. We're going to buy a call as insurance premium. We're going to then sell a put right at the money, right on top of it. We're going to just drop it right on top, and then we're going to buy a put, okay? So if we do that, what we have is we end up with our iron butterfly. So now the whole idea here is that we are selling the premium to collect the premium, or selling the options at the money to collect the premium, both a put that we sold and a call that we sold. Now this, if you come over here and look, we're going to receive, with this particular setup, we're going to receive $385. The return on our risk is going to be 55%, and the margin required is $700. So the buying power decrease is 316. So you can see our options set up in here in this little window, just like we had on the diagram before, right? So if you take a look at this little box right down here, it looks exactly like our diagram here that we had before, right? So that's where that comes from. So you can see this little diagram over here on the right-hand side. That's what it looks like right here on the PowerPoint slide. So you can see the same thing in both places, and that's what your iron butterfly should look like when you put one of these on. Now, I'm going to go through and take this off and put it back on one leg at a time and show you how things work out. So let's go ahead, and we're going to cancel this. I want to put on the sold options first. So we're going to sell our call at the money, and I want to just drop that in there. And the very first thing is just one option. You can see that we sold it. It's a naked option. This one's naked. It doesn't have any insurance on it, all right? So it's driving around your truck without any insurance. If you get in an accident, you're going to have to pay the full amount all by yourself. Okay, there's no insurance on it. So what we want to do with this is, because we don't want to have unlimited loss potential, and if you look at this thing, you're going to have a margin requirement on this thing of about probably $10,000, all right? So we don't want to have that. So we want to have a margin reduction, and we also want to put some insurance on it. Now, the insurance is going to cost us something. We have to pay a premium for that insurance, right? So when we buy a call, we're going to come in here and drop this call on here, and it depends on how much we want to pay for that insurance. Now, we're going to receive $268. All right, so $268, how much do we want to pay on our insurance policy? We could come out here and we could pay we could buy a 30-day insurance policy. We could buy a $50 insurance policy. Each one of these are all going to be 5 days. Sorry, I said days, but we're going to have 5 days for the insurance policy, 5 days for the option that we're selling. But how much do we want to pay for the insurance? The more insurance you buy, the less deductible you have, right? But the higher the premium. So if you want a higher premium on your insurance policy, there's an insurance premium for $132, and we have a smaller deductible. But in this case, we only are making $268, and we'd be spending $131 of that on insurance. So are we overinsured? Do we have too much insurance? Maybe. So we could loosen that up a little bit and come up here and buy some insurance, maybe $50 of insurance. But the idea of this is you have to decide how much you feel comfortable with, and you're going to do that based on where you think this market's going to go. If you think the market's got more of a downside potential, you're going to want more insurance to the downside, less insurance to the upside, right? Or you could just do equal insurance. And usually when we do an iron butterfly, we just kind of think the market's going to go sideways, so we do equal insurance on both sides. But this is just looking at it one side at a time. So this is the call option that we sold, and we need to buy a put option to cover that insurance policy on the other side. So I'm going to come in here and run this up here to about $30 of insurance. Okay, so we're going to buy $30 of insurance, and that's going to reduce our outlay for our margin amount that we have to have, because we have to have margin when we sell a call, right? We have to have a margin performance bond, and then that's going to drop this down significantly. So our margin went down from what would have been probably about, maybe not $10,000, but almost $10,000 down to $800. So we now have a margin requirement of $800, which is much more manageable. We have our insurance policy put in there. That makes the exchange very happy. So now they're not worried, and that's why they give you a much lower margin on this thing. We're spending $30 of our in this case, $269 of the premium that we're going to collect. We're going to spend that on insurance to protect us to the upside in case that market goes crazy. Because we want for the next 5 days for it to do nothing. We just want it to go sideways. All right, so the next thing we want to do is, this is the upper leg or the upper wing of our butterfly. It's only one wing. It's the call wing. Now, if we want to put a sell wing on, and you may not. You may decide, hey, look, I'm bearish on this market, and I think the market's going to fall. You don't have to put on the downside wing, all right? You can just say, no, I'm just going to put on the upside wing, and I'm happy with how much money I'm going to make here. If it stays below my red line, and it falls, I'm going to make my full $267 minus my insurance premium of $30, and I'm happy with that. I don't need to worry about that. You're just basically taking a position in the market and saying, I want it to fall. I believe the market's going to fall, and it's going to stay below that red line by expiration. Okay, and if that's the case, then you would make your full $267, pay your insurance premium of $30, and you'd be golden. But if you think, well, the market's going to go sideways, I don't think it's going to actually fall. Now, just incidentally, if you did that, just one wing, that's called a bull call spread, all right? It's a vertical spread is what we call that. It's actually a short bull call spread because you're selling it, you're not buying it. So you're putting it on, you're selling a bull call spread, and you are taking advantage of the fact that premium's going to decay. You're going to keep the premium, and the market's going to fall below that red line, and that's what you think. So you're selling a bull call spread. So a iron butterfly, if you want to think about it like that, is a bull call spread and a bear call spread on top of each other. All right, two shorts, because we're going to sell the premium. We're not going to buy them. Okay, so we're going to short bull call spread and a short bear put spread. So it's a bear put spread to the downside, bull call spread to the upside, and because it's a butterfly and it's a negative strategy, we're going to be selling both of them, not buying them. Okay, so now we're going to put on our short bear put spread, which is the other wing of an iron butterfly. Okay, so once you kind of break these things apart, they all kind of work one with the other. And when you do one side of one or one side of the other, they have different names. So there's about 21, 22 different options that are recognized by the exchanges. I think it's 21 different option strategies, maybe 22. I have to look at my book. But I think there's like 21 or 22 option strategies that are recognized by the exchanges. And out of those 22 option strategies, most of them are just kind of derivatives of each other. Like the iron butterfly is just a bull call spread and a bear put spread that you're a short one. So if you're going to, depending on whether you're going to buy it or whether you're going to sell it, whether you're going to put it on for a premium collection or whether you're going to put it on for a move in the market. So either way, it's, they're just kind of stacking these different strategies on top of each other and then giving them different names. So once you understand the process of selling a put and buying a call, or buying a put and selling a call, it's all the same. They're just, different variations of doing the same thing and then kind of deciding where the market's going to go in relationship to those strategies. So that's what the strategies are for. It's like playing chess and you're saying, well, I think the market's going to go up, so what's the best strategy to take advantage of that? I think the market's going to go down. What's the best strategy for that? I think that the market's going to go sideways. What's the best strategy for that? And we have the strategies broken down into groups. Which strategies are bullish strategies, which ones are bearish strategies, and which ones are neutral strategies. And then you decide what you think the market's going to do, and then you pick the strategy that best aligns with what you think the market's going to do. Again, it's like playing chess. You just have all these different strategies to attack the market or your opponent, right? The market is your opponent. So now we're going to come in and we're going to put on the other side of this this short bull call spread. We're going to come in and we're going to put in a short bear put spread, okay, or bear put spread. Yeah, that's what it is, a bear put spread. So the other side of the bull call spread, but we're going to do a short side. So we're going to come in here and we're going to sell the call. Nope, sell the put because it's the put, and we're going to drop this right on top, the exact same spot as the one that we sold, the call that we sold. So we drop that right on top, right at the money. And now we're naked, right? We have three options. One's covered, one's not. The put is not covered. It doesn't have any insurance. So you'll notice that our margin requirement went all the way up to $10,000. So there's your $10,000 margin that I was telling you about. And when you drop that option on there, it has $10,000 in margin because it's not covered. There's no insurance on it. So you have to cover it yourself with your own cash. So that's the same as if you had a car and you have a liability of driving around without insurance. If you wreck it, you're going to have to pay the whole car insurance. So let's go buy some insurance. And the way we do that is we buy a put and we drop that in here. And where do we want it? How much insurance do we want? The closer we have it to our strike price, or closer that we have it, the better insurance we have. Of course, the more money we're going to pay for it. So the premium of our option is our insurance policy. That's how much we're going to have to pay for it. And then we decide how much of a deductible we want. How much, if you're wrong and you crash your car, how much are you willing to pay for that? Now, since we went out to $30 on the other one, on the other side, we can go out to $30 on this one. And we can have our insurance policy down here. So there's roughly about the same, $32.50 on this one. So we put in our other leg. We could click on that, and that would put in our other insurance policy, and it'd significantly reduce our margin amount. So we can go ahead and do that. We click it. And that adds it to the mathematics over here, the little ticket over here on the right-hand side. Now you can see we're going to receive $415, where we have a return on our risk. That's going to be a 51% return on our money in 5 days. Okay, the margin requirement on that went all the way down to $800 when we bought our insurance. So that is our deductible. All right, the $800. That's our deductible. That's the maximum amount of money that we can lose in this strategy if we let it go all the way to the end and it's outside of our box. We crash our car. We're going to have to come up with $800 to cover our loss. All right, the maximum amount of money we could make is $415. So you're like, well, that's not a very good risk to reward ratio, right? Not a very good risk versus reward ratio. I'm risking $800 to make $400. Well, the reason we're willing to do that is because of the probabilities. So if we come down here into the probability table, you take a look at your probabilities of the market going outside of that, and you can look at your delta probability, and you can see that we have on these options that are at the money, we have a probability of about 50-50, okay? Probability of being in the money is 53, probability of being out of the money is 46. So we have basically a 50-50 chance that market's going to be out of the money or in the money. So when you do anything at the money, that gives you basically a 50% chance of being in the money because, and I'll pull up one more little chart for you here. If you've been attending my live classes, you know that this has the cone of probability. So calculating the delta cone of probability during any span of time, 68.2% of the time prices fall within a 1-to-1 standard deviation of the average. So that means the market's got a 68, almost a 70% chance of staying inside of our 1-to-1 standard deviation cone of probability. So that's why we kind of put those insurance premiums out there far enough, about 1 standard deviation away from the at the money. And that gives us basically a 70% chance of being right. All right. Now, stocks fall within the +2 or -2 standard deviation only 95.4% of the time. So going way out 2 standard deviations away from where we put those options on, we have a 94.4% chance it's not going to go out there. So if the market doesn't have a very high, a 5% chance of going out to these wings out here, basically this standard deviation, then why not take that opportunity to, capitalize on a dead sideways market? So obviously, the longer time you hold on to that, the bigger the chance is that it can move outside of a larger standard deviation. And the way we generally do that is if we're going to go out 5 days, we're going to go look back 5 days. So we look back 5 days, find out what the average high, the average low is, go out 1 standard deviation of that, and that would be our 2 standard deviations. And that's where we could put our wing. Okay, so that's kind of how we decide how far out or how much insurance we want based on these probabilities. So you just want to have your wings out at these probability levels depending on how much insurance you want to buy, right? So take that into consideration when we do this. And we're going to do more of this. We'll do more of these and it'll make more sense. And we'll do some of that standard deviation stuff as well, determining when's the best time to put these options on. Right now, I just kind of wanted to show you how to do it. And this is how you would do it. So I'm going to go ahead and I'm going to drop this thing in here. And for now, I'm just going to mark it into it. We're in the demo account. We're going to just mark it into these things and get into this market here on the Qs. Okay, so now we got it filled. We got our iron butterfly filled, and you can see over here that we go into our positions, and you can see it all right down in here. We're sitting negative right now. We just want this market to die on us, die for us. We just don't want it to go anywhere. At this point, we want it to go straight sideways. Now, we're going to come in here, and I'm going to show you my cone of probability in here. And I probably ought to do that on a little bit longer term time frame chart. Let's come in here, and we're going to turn this 15-minute chart into a 4-hour chart. And we're going to see our cone of probability. So what we really want this market to do, I'm going to flip those texts over to the other side. There we go. Our cone of probability in this case is going to be the difference between where we got in and where we're going to, options going to expire. So we're going to go like this. We're going to just draw a cone of probability. And right there is our cone of probability. We want this market to stay inside those arrows. If it goes outside those arrows, we're going to lose money. All right. So we're going to lose some money. Our call options are going to make a little bit of money. They're going to start, our call option to the upside will start making money if the market leaves that, and it'll start at that point making as much as we're losing on the option, right? So the amount of money that we looked at our max loss was $800, which is going to be our deductible inside of this market in case it goes out farther than those outer wings, okay, where the insurance kicks in and starts paying us off. So our max loss is 800, but that would mean it would have to be, the market would have to go up in this region, up in here, right? It would have to be up in here to start losing that kind of money. So that would be our max loss if it went outside of that box. So we don't want it to go outside that box. We want it to just stay inside that box and hit that purple line inside that box, and that's our cone of probability. If it goes outside the cone of probability here at the beginning, you'll notice you got an easy chance for it to go outside the cone of probability in the beginning because the cone of probability is very small. So if it starts to rally right now and goes up, it's going to show a big loss. But it could come up. Watch, the market could come up, and I'm going to spread this out a little bit so you can see the cone a little bit better. But this market it could come up here and you'd show a loss. But then if it came back in and hit that purple line still inside that box, you're going to make your full profit. All right. So anytime it leaves that box, it's going to show a loss. But as long as it comes back into the box and hits that purple line inside the box, you're going to still make your full profit anywhere inside that box. And the reason you got the cone is because if it stays inside the cone, it'll probably show a profit the whole time it's inside the cone. If it leaves the cone, that's where it'll show a loss. But as long as it comes back inside the cone by expiration, it's going to show you a full profit of about $500, right? That's what we calculated on this thing. Now, what if it comes all the way out here? Well, even if it comes all the way out here, as long as it comes back in, we're still going to be good. Now, yes, there are things that we can do to start mitigating our problems if this thing comes all the way out. We can start selling and rolling out our wings and doing some risk management on there, but that's beyond the scope of this video. I just wanted to bring your attention to how you set up and why we set up these iron butterflies and the profit potential that they have and what you're looking for them to do in this strategy, in this chess move. All right? So that's iron butterflies.